My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Arjun Murti, who's got a real pedigree when it comes to the energy space. Arjun, for those who are not familiar with your background, set the stage. Who are you? How'd you get involved, in particular in the energy sector? And what have you done throughout your career?
Yeah, thank you, Michael, and thank you for having me here. I've been an energy equity research analyst for, I'd say, 30 years now. My career started in 1992. And for the first 22 years, it was primarily as a sell side analyst. The bulk of my career was at Goldman Sachs. I was on the buy side at JP Morgan for a few years and started at a small boutique investment bank, Petrie Parkman in Denver. Retired from Goldman in 2014. A little bit burnt out at the time. I was co-director of America's Equity Research. Definitely didn't love management, and I much prefer analyzing oil equities. And since then, I've been in a series of, I'll just call it behind the scenes kind of roles. People can see the profile on LinkedIn, but I'm on the board of a large oil and gas company. I'm a senior advisor at a private equity firm, and I'm a senior advisor at Columbia Center on Global Energy Policy. And I've been doing that for the last 8 years. And I started writing a Substack. It's almost been the 1 year anniversary. It's called Super Spiked. It is for free. It's arjunmurti.substack.com. And really the motivation to writing it has been sort of my dismay at how people talk about energy transition and what is feasible and what's not feasible. And it basically lacks pragmatism. And instead, there's so much extremism on either people are climate only ideologues or, they're against the whole thing. And I try and bring the voice of someone who's covered the sector for 30 years now to Super Spiked. It's not an investment newsletter. There probably are investment conclusions one could glean if they so chose. But the purpose of Super Spiked is to try and have a voice to a more pragmatic, what I'm going to call a healthier energy evolution era than what I think is a pretty messy energy transition that I'd say we are unfortunately otherwise on track for. And just as a final point, Michael, I'm definitely here speaking on my own behalf. Please please don't anyone blame any of the companies I'm currently or previously affiliated with for any of my views. Blame me. They're all on my own. I speak here on my own behalf. And again, thank you for having me.
All right. So it's interesting to me that you mentioned extremism, because that's obviously not anything new. But I'm going to make the assumption that in all of your time covering the space and being involved in the space, that you've never really seen something quite like today, where there's such an aggressive pushback against oil and gas by, let's say, far left. I'm curious, why is it you think over the last several years the sentiment against oil has gotten increasingly more extreme? What's the real driver behind that?
I think there's a confluence of factors, and I'd say the switch really occurred, I'm going to say, in the 2018-2019 period, and things like ESG and focus on climate, and those are two different things, by the way, and I think should be treated as two different things. They've always been there. I mean, I can go back to the beginning of my career, and we used to always talk about these kind of things. I owned a company called Tosco when I first joined JP Morgan, and they were good at buying refineries for pennies on the dollar. But we used to wonder, are they cutting corners on maintenance capex? Are they or aren't they? So a lot of these things that we might call ESG today, I think we've always taken into account as investors or analysts, and which management teams do we trust or not trust, and so forth. But there's something about the last 3 or 4 years we just flipped, and I think it starts with the energy sector. The traditional energy sector did really poorly over the previous decade, and it had gotten to the point where it fell from 6 to 12% of the S&P, which it had been for really my entire career, to an irrelevant 2% of the S&P. And once you're in an irrelevant portion of a major index like the S&P, it's true for the other major markets out there, investors don't have to care anymore. And you couple that with then the same time concern about addressing climate change and so forth have really moved to the forefront. And listen, whatever I say here, I support energy for all. And ultimately, if we can do that with as low a carbon of an energy intensity as possible, but you got to provide energy for all. It's got to be available, affordable, reliable, and secure. And then once you deal with that, let's try and address the negative externalities, which we've always done. We've dealt with lead in gasoline. We've dealt with NOx and SOx. We used to have a brown cloud when I went to college in Denver. That's now gone. And I think too much carbon is something we have to deal with, but it can't start with hating fossil fuels. So I think it's possible to dislike the oil and gas sector. I've covered it for 30 years. I promise you, I've not always been in love with it. There are times I've liked it. There's times I've disliked it. I think it's possible to like or dislike individual companies or executives even. Some are good, some are not so good. But the idea of hating fossil fuels themselves, that I do not understand. And maybe, Michael, if you're not an energy specialist, I would love to hear your perspective because really, since the Industrial Revolution and development of first coal, then oil, then natural gas, it's been a miraculous time for humanity. We've got a rapidly growing population, which is a good thing. We've had amazing economic growth. We have the least number of people living in poverty ever, and a huge everything we do is driven by fossil fuels. There's nothing you do that isn't. This Twitter Spaces is ultimately driven by fossil fuels. Clearly, the cars we drive, the planes we fly, Amazon Prime. If you're getting 3 packages a delay after a click of a button, that's driven by fossil fuels. It's 80% of our primary mix. There is not a single thing we do as a civilization that doesn't ultimately depend on coal, oil, or natural gas. So you can say, you know what, that's fine. I am concerned about too much CO2 in the atmosphere, and that's fine too. That is something to be concerned about. But the idea that the answer is to abruptly cut off and protest and divest fossil fuels themselves seems pure insanity, and frankly will lead to worse economic outcomes and worse health outcomes in the short term. That sort of very anti-fossil fuel sentiment is helping the sector because capex is not rebounding to what are much better profits, and there's a lot of reasons for that. But the sort of inherent, it's like no one likes filling up with gasoline, right? It's not fun to. I drive a Tesla because I prefer charging at home. I think that's a much better experience than going to a gas station, as an example. But we all, for sure, like all the lives we lead. And I think what is most unfortunate is there are a billion people that have really nothing when it comes to energy usage. And there's 3 billion people who are generally energy poor. How can we have policies that are going to leave those people behind? And so, again, when you think about this anti fossil fuel sentiment, again, you can like or dislike the sector. You can say they're doing things that are helpful or unhelpful. You can like or dislike companies or executives. But why would you dislike fossil fuels themselves? But all of humanity is dependent on them. We've never had fewer people living in poverty than now. We've never had as healthy of a population growth as we've had in the last 50 to 100 years. And that is all thanks to the fossil fuel industry. I would like to decarbonize, but you can't do it by saying we're going to cut off the source of everything that drives us based on some ideology, and that's really where the issues are today.
Yeah, and in hearing you talk about this, it makes me think that the reason why you have such heightened emotions when it comes to the space is more behavioral finance, human psychology oriented than not, right? So, what does Hollywood often do when it comes to certain movies or TV series? They tend to make the oil baron the villain.
Yep.
Increasingly, people's attention spans are getting shorter and shorter. So they're reacting Daniel Kahneman's system one versus outright thinking, which is the system two, which is more deliberate. And increasingly, people are just responding. And to your point about you can't just kind of pull the plug on oil and gas and overnight suddenly not use it. That requires a little degree of thinking. Unfortunately, I think people are just too reactive and perhaps utopian in thinking that we can totally decarbonize, in a very short term way.
I mean that's exactly right. And so let's quickly touch upon, is the lack of investment the fault of ESG crazy people? And I will say no. I would say the number one reason the capex response has been slow this time is not because of President Biden, and you can like him or dislike him, and I definitely, and I'm sure you don't either want to turn this into a political debate. That is not my point in saying that. But my point, but what I would say is that the sector stunk the last decade. It was a 0% return on capital from 2011 to 2020. So if you're an investor and you're already concerned that, hey, over very, very long periods of time, it's kind of a cost of capital sector, 8, 9, 10%. Yet over the most recent decade, it was a 0% return on capital. By the way, that included 4 years of $100 oil, 2011 to 2014. This wasn't just about some post 2014 crash, and it's not even just about the terrible trough that happened with COVID. So if you're an investor, you're going to say, you guys, you cannot waste my money again. I want it all back in the form of dividends. And I would say That is the overwhelming reason for why the CapEx response has been slow. Now, on top of that, we will layer in what I think are really bad policies that we're seeing out of especially the US, Canadian, and European governments. I will attribute very little of the current low CapEx to those policies, but I think they start to bite as you look out in future years. So we could use more, for example, oil sands production. I don't think Keystone XL has happened or not happened uh, just because of politics. And when oil's $50 a barrel and the return on capital is zero, no one's going to be building a whole bunch of oil sands projects. But now that oil has rebounded, and I will call Canadian barrels, I've called them good barrels, and I think there are both good barrels and bad barrels in the world. Now we need pipeline infrastructure, and we need to, I think, figure out ways to rescue Canadian oil, not necessarily because America needs it, but because the world needs it. If you look at US and Canada, we are broadly balanced on our supply and demand. And so someone will say, well, I've got this nationally determined contribution for CO2. We should not produce more oil sands. It's high polluting, quote, high CO2, high polluting oil. And that, first of all, it's not factually true. When they build their CCUS hub, and they may or may not, they need to show that they're doing that. That will take away all the carbon disadvantage of Canadian oil. Over long periods of time, Canadian oil is comparably profitable to rest of world oil, including U.S. oil. And I would say that if you're a rural person in India, if you're a poor person in Africa, why should you not get access to Canadian oil? Because of some stupid nationally determined contribution? It makes no sense. Canada's got 30 million people. Who cares what their carbon footprint is? What matters is the US, Europe, China, and India, obviously. But so we're going to have politicians say Canada oil needs to be shut in because they've got some Paris target. It makes no sense. Or eliminate that from the Paris target. Address Canadian demand if you want to. Make Canadians drive more fuel efficient cars or what have you. But let free Canadian oil to be produced for the rest of the world. So I think a large part of this is the sector has not done well and is starting to do better. But as we look forward, as we look to the next year ahead, 3 years ahead, 5 years ahead, there's some really troubling stuff that is the outgrowth of climate only ideology from politicians, from some folks in the ESG crowd, and from things like the divestment movement. And we can get into that. But the Munich Re news from 3 weeks ago is should scare the heck out of everybody. The German insurance company, again, whatever you'd like to talk about, we can. But I think the go forward concern is this climate only ideology is going to be the thing that going forward keeps the oil in the ground because the returns and the profitability is now much better. And normally we would be seeing more of a CapEx response at this point in the cycle.
That's actually an interesting point to discuss too, because I would have thought that there would be so much pushback against ESG that you at least cool off the extremism. And it seems, at least from the things I see in the news, that it's almost like there's a doubling down now of the climate ideology in the context of the role of oil in the global economy. How do we get past this stage where the two sides are talking past each other? Because I don't believe it's mutually exclusive. You can be, to your point, right? You can be pro climate and want to decarbonize, but still use oil.
I think that's 100% right, Michael, and I appreciate your making that point. That if there's a conclusionary point, it is that you're going to have to learn to walk and chew gum when it comes to energy. A healthier, let's just talk about, let me try and be positive here. A healthier energy evolution is one characterized by, frankly, robust US and Canadian oil and gas supply growth. And I think, frankly, things like addressing methane, moving to near zero methane, is something we should demand of American and Canadian companies. We know they already have some of the best labor standards. By the way, Mike, if you have children, there's no question you'd rather them work in the Permian Basin than work in an Amazon warehouse or on a Hollywood movie set. Those safety stats are not even a close call. So we know US Canadian companies already do better on things like labor, health, safety type standards. You can hold them to a zero methane requirement. I think they should be held responsible for ultimately reducing their scope 1 emissions. But let's maximize US and Canadian oil. There is geopolitical implications to protesting US, Canada, and Europe. If you're Munich Re, a German insurance company, and you say, I'm no longer going to underwrite oil and gas, what oil and gas are you no longer underwriting? Are you no longer underwriting Russian oil? Again, I don't cover Munich Re. I'm an oil equity analyst. Were they underwriting National Iranian Oil Company? Is that what they were underwriting? Or was it primarily US, Canadian, European oil and gas? Why, if you're a diehard environmentalist, would you focus on US, Canada, and Europe first? It absolutely makes no sense. It is bad for the economy. It's bad for jobs. It's bad for the environment. It's bad for worker safety. There's nothing good about that. And so this idea that, oh, we need quick climate action, that it is that psychology that really oddly, I do not get it. I do not understand it in the least. It is driving this uber focus on just our own companies. You want to protest Keystone XL? Go for it. Why not go to Siberia and protest the environmental damage there? Why not protest Iranian export facilities? How does that make any sense at all? So I think there are huge issues with climate accounting, scope 3 emissions, and nationally determined contributions. I'm in favor of diversity. Where's the diversity in the folks that made up those rules? There's no chance they included any business people. They definitely didn't include Northeast equity research analysts for sure. No one would have come up with these rules with half a brain. The scope 3 emissions and the nationally determined contributions. So I think um, you need to solve for all aspects of energy. Energy is life, as others have said. You need available energy, affordable energy, reliable energy, secure energy. And then you also need to then deal with the negative externalities, things like too much methane, too much CO2, other NOx and SOx issues. We can deal with all of that. You're much more likely to do that in a healthier era and environment if you do it with US and Canada. I'm in favor of holding US and Canadian companies to the highest environmental standards. But the highest standards include allowing pipeline infrastructure to get developed. It's a lot. So, for example, if you tell a company no methane flaring, how do you do that? You do it by basically mandating that you do not get to develop an oil field without also ensuring the natural gas midstream processing pipeline and gas handling takeaway capacity is there. And I'm completely comfortable with that. You will actually get better profitability when companies are forced to focus on full cycle returns. A big reason why shale stunk last decade is because people focused on these idiotic well IRRs. And maybe that's too much minutia, Michael, for this audience, but they focused on just what is the cost of drilling the next well, and they thought the price of oil was good enough to do so, and that was not the case. When you are forced to factor in environmental standards, pipe flaring, and these kind of things, I will argue you will have better profitability. The profits, and I'm going to call that an ESG focus, those profits will be better when you focus on full cycle returns. And so again, US, Canadian, Europe, why would you protest this stuff? It makes no sense.
And it seems to me that there's another inconsistency, which is that, and you kind of alluded to it, right? You can uphold various countries to environmental standards, or at least most countries. I often find that a lot of this discussion around decarbonization and oil seemingly is leaving out the 800-pound gorilla, which is China. And it's hard to get real standards there. And of course, you can argue that China as an emitter of CO2 is driven because we are consumers buying all of the stuff that's being made there. How do you think about China in terms of that energy transition? So many months ago, I had David Fishman on, who's in China and does a lot of the energy transition stuff, for a firm that he works for in China. I'm curious to hear your thoughts on how that dovetails into what we're talking about here.
I mean, the biggest issues going forward are going to be China and then followed by India in terms of emissions. And I think the number one challenge will be that if you're China or if you're India, everybody should want and everybody will want the lowest cost form of energy supply you can have, full stop. That's true in the United States. It is absolutely going to be true in China and India. And what is their lowest cost form of energy supply? It's going to be coal. And they've got massive coal resources, both countries do. That also means local jobs. And like any industry, there are multiplier effects. So it impacts rail, it impacts service industries. It's a huge multiplier effect positively if you're within that country. One of the challenges with natural gas is if you're importing it, you're paying basically world equivalent oil prices, and it's not going to be your resource. That's an unfavorable trade. This is one of the reasons why I am in favor of essentially zero methane natural gas. It can't be that natural gas, from a carbon perspective, if you account for methane, may only be slightly better than coal. It's going to be better than coal, but perhaps only slightly. You're definitely not going to want to pay world oil equivalent prices for something that may be only slightly less carbon intensive. And so I think it's incumbent upon the natural gas industry around the world to move to zero methane type gas. And I will say, I think this is a huge opportunity for US and Canada. And I suspect that countries like Qatar and United Arab Emirates and even Saudi will figure out ways to ensure that their oil and natural gas is as low methane, low carbon intensity as possible. We could all probably spend another 5 hours debating that, but I'd actually say good for them for at least I think going down that road. I think the Permian Basin needs to figure that out as well. So if you're China and India, and you're going to be doing a whole bunch of now, the thing that will get some climate progress made there is some correlation between wanting to clean up your air and biodiversity and water, which are all important things that as society becomes richer, they care about. Right? Michael, which countries have the cleanest air? The ones that use the most fossil fuels. Is that because fossil fuels clean up the air? No, they obviously do not directly clean up the air. What they do is you're richer. When you use more fossil fuels, you are a wealthier country, and then you can do all the things like cleaning up the brown cloud that went from the LA basin to Denver when I was in college, right? And so that demand for we are now a wealthier country. We don't want to be breathing in these fumes from these scooters that just drive around the middle of Mumbai, or you have to burn cow dung because you don't have any energy in your home. What like for anyone who's burning cow dung in their tent on the side of Mumbai airport, do you think they might like coal or diesel or solar or I think anything they can get, right? But there will be a correlation between, I'll just call it traditional environmental standards and decarbonization to a degree. The only opportunity, and this is not my original thought, and it's not even my area of expertise, is going to be nuclear. You then don't become dependent on importing external resources for the most part. Clearly, uranium's an issue. But it is not like what we have, say, Russia cutting off gas or disruptions in various countries impacting oil flows, what have you. If you really want a low carbon source of power generation, it is going to be nuclear. And I think China seems to be doing a good job on building nuclear plants. They seem to be able to do it much quicker than we can. I'm not an expert to know the exact reasons why, but I know they do it faster than we do. And I think India will have to go down that road as well. But I think where there is, I'll just call it positive hope for decarbonization, it will come from the focus on traditional water, air, and biodiversity. But I'm very suspicious that if you've got a large domestic coal resource, you're going to want to be importing foreign sources of, say, natural gas. So I don't think there's an answer, Michael. I don't think there's an answer to how they're really going to decarbonize in China and India. Yes, thank you, Mr. Aziz. Thank you for your questions. And I'm going to address the second part of your question first, and I think it'll lead back to the first part of the question. So one of the key things I talk about in my Substack, and it's always been a key focus of mine as an equity analyst and so forth, has been the return on capital cycle. And my career is 30 years, so I've looked at it super closely for those 30 years. And then when I was Goldman, we should do the work to take it back 50 years. I've been put to shame by another Substack. It's the Crude Chronicles. I'm pretty sure it's free. I would highly recommend everyone subscribe to it. That person who writes that has taken things back 100 years. And that is just awesome that someone's willing to go pull the annual reports and do that. But the point would be the returns on capital cycles for this sector are long-term in nature, and they are not one-to-one with the oil price. If someone listening to this is a trader, maybe with a day, weekly, monthly, quarterly view, then for sure, if oil fell $40 in the next 3 months, I'm sure energy equities would be down and probably vice versa as well. But for anyone who can look in sort of a multi-year period, it is not one-to-one, and it's critical to understand that. So again, I could spend probably 5 hours talking about this. Let me try and give the short answer. If you look at the 1990s, oil was $15 to $25 a barrel. The companies earned an 8 to 9% return on capital. By the end of the 90s, with restructuring, super major mergers, they were up to 10 to 12, and good companies like Exxon were up to 14, 15%, still at $15 to $25 nominal oil. We then start the super cycle. We ultimately go from 20 to 140, and that is the call that people will remember from my Goldman career, my career making call. We called it our super spike call. What's noteworthy is from 2002 to 2006, oil went from 20 to 60, returns on capital went to the mid 20s, great returns. From 2006 to 2008, oil went from 60 to $140 at its peak. It averaged $100 in 2008. Returns on capital actually fell. CapEx started the second the cycle started. Throughout all of history, all companies, including the super majors, have all had at least 3 to 5% growth targets. And of course, if you're an E&P, 10, 15, 20%. That's always been true throughout my entire career and including during that super spike period. But returns peaked in 2006. And you know when they troughed? 2020. We went through a 5-year downturn. And that is the nature of these return on capital cycles. They're 10 to 15 years up and down. Now, in 2006, yes, we had the great financial crisis, but we rebounded from it. From 2011 to 14, we averaged $100 oil. Returns on capital fell every year and ended up at 8%. We had the same return on capital at $100 oil in 2014 that we did in the 1990s at $15 to $25 a barrel. And my biggest regret when I was at Goldman wasn't that, oh, Arjun, you doubled down at some point in that cycle. You should have stuck with just the original call, or you didn't call. I'm not going to call a housing crash. I mean, I will excuse myself for not having done that. But what I don't excuse myself for, and what my biggest regret is, returns on capital started to fall in 07, and they were definitely falling in 11 and 14 versus that 06 number as oil prices were much higher, and the capital intensity had just caught up. Everyone was trying to grow all sorts of new projects all over the world. And that is what I'm about. So my regret is not ignoring that lesson and saying, hey, returns are still pretty good. Pretty good is not the right answer when you're going from 25% to 15% to 8%. That is a bad, bad trend. And then we crashed in 15. We've had come to a first bottom in 16. Again, I will excuse myself as an analyst for not calling COVID. But we had another trough. Now, 2022, we're going to have 25% returns on capital this year. I will say that this is year 2 of a decade-long upcycle in returns. And I want to be clear. It's an upcycle that will end when capital intensity rises and we then have a down cycle again. But you have to spend money. There is only one way to cure fundamental energy tightness, and that is through CapEx. The Fed can raise rates, and the Fed can perhaps there's some better podcasts and people who come pontificate about how good or not good the Fed is. I love Jeff Snyder as one of the guys who I think has some very interesting contrarian views on the Fed. But let's just be basic here and say the Fed's raising rates, it could lead to recession. Yeah, that could cause a pullback in oil. That's why I propose a super volatility mindset. If you have a recession, prices can pull back. But I think we're in the early innings of a decade-long ROC super cycle. And it's many different factors. That is the nature of these markets. It takes time to go find, develop, and explore new oil and gas fields. And right now, it is uniform. Everybody, traditional investors, ESG investors, climate-only people, and public policy people in the United States and Canada and Europe are saying, don't invest. No one wants anyone to invest. It's the fault of everybody. And I am very forgiving of traditional investors because the returns on capital, as I've mentioned several times, now stunk last decade. But now we've got 25% returns on capital. We normally would be getting more of a CapEx response. I know CapEx is up a little bit this year. I suspect we will have CapEx growth next year, but you're far from where we were 15, 20 years ago. In my entire career, throughout all of it, every company had a too robust growth target for what their core business could develop. Now, the only competition is who can raise their variable dividend the highest. And let me tell you, as an equity analyst, I will never criticize companies for competing on dividend growth, but that's also not sustainable either. These are depleting businesses. And so if your asset life isn't particularly long, and by the way, Canadian oil companies have very long asset lives. Almost no one else does. LNG companies do as well. You're going to have to reinvest, and everyone's saying don't reinvest. And so we're not on track to solve this energy tightness. And I will say, to part of your first question, is you didn't say this, so I want to be clear that I am saying this. The world is not short resources. There is plenty of oil and natural gas in the United States, in Canada, in Saudi Arabia, in UAE, in Qatar, in large parts of Africa, in Venezuela, Mexico, Brazil, Argentina. And I'm naming countries that you may have a view that their politics aren't going to allow investment. That's absolutely true. And I think Venezuela is the saddest situation throughout my 30-year career. They have the greatest heavy oil resource in the world. It cold flows several thousand barrels a day. There's no greater oil in the world. It is as great of an oil in the world as any other resource. But who's to say these countries are going to open up? And we know in the places where you can invest or you should want, Canada is saying we care more about our nationally determined contribution than ensuring that poor Indians, poor Africans get access to our oil? Where is the environmental and social justice in that? More Canadian oil is good for environmental justice and social justice, as an example. But I don't think the world is running out of resource. And I don't even think the world is necessarily running out of low cost resource unencumbered. Now, that's a big word to attach to it because it is highly encumbered. With all the anti fossil fuel public policy and rhetoric we see, that is going to contribute to higher costs. Now, some of it I'm okay with. If you tell me that it costs something to eliminate methane, I think we should eliminate methane. If that costs something, let's do it. I will say the first, an engineer on the call can correct me, but it's probably the first 50% of methane reduction. I'm going to say you're going to generate more revenues than cost. And maybe it's that last 30 or 50% where the cost curve starts going up. So I will, I'm not pushing back on you, but I'm pushing back on the notion that being environmentally conscious as a company is somehow unprofitable. I don't think that's true at all. And so if Saudi, for example, has to do water desalination, then perhaps the market is understating what their costs are. But I think I'd be very confident that if Canada wasn't held up by public policy in its case, that Canadian oil could be developed quite profitably. Venezuela needs a radically different government, and I'm not projecting that or anything. That's for a different conference call. But I'd say if you went back to the type of administration they had in the 1990s, you could have very profitable, low-cost Canadian oil growth. So I don't think we're only going to be in a high cost oil environment, but we are for the foreseeable future because the policy's not where you need it to be. Thank you for your question. What I will say is there will be no choice other than to at some point get to sensible energy and climate policy and environmental policy. There's no choice. And the reason I say that is you got 5 billion people on Earth, 5 billion people who are used to being able to drive their car every day, to drive their truck because there is sufficient diesel fuel. What happens when there's not? Who like flying in planes that can fly because they use jet fuel? What happens when there's not? Right? You know, your children and even parents, you can't go 5 seconds in a power outage without worrying about your iPhone dying. No one can live without this stuff. And then what about again the 1 to 3 billion people who, not due through no fault of their own, maybe the fault of their governments, don't have access to this, right? So there's going to be no choice but to have ultimately sensible energy and climate policy. It's just a question of how long it takes to get there. And so, I think for people who worry, hey, returns on capital for the sector, aren't they peaking now? Whether this year's return is higher, ends up being higher or lower next year, is going to be a lot of factors that drive that. Again, I think we're in year 2 of what's going to be at least a decade-long period because you need to start a capex cycle. When you have a normal capex cycle, as has happened over the last 100 years, these things kind of last about 10 years, and we're in year 2. Now we've got this insane perspective that somehow we don't like fossil fuels. And again, I'm totally okay if people don't like individual fossil fuel executives. Not all of them are great human beings. Some are, some aren't. Or companies. Some are good companies, some are bad. No problem at the individual level. But as an actual thing, fossil fuels, why would you hate fossil fuels? It makes no sense. It's absurd. It's ridiculous. Right? And so we can't live without this stuff, and we won't. Um, it's just a question how long it takes people to get educated on this stuff. In that sense, again, I don't personally kind of blame ESG. I think ESG is a broad issue. And I think the substantive part of ESG is needed. There's no one who could dispute governance is needed. Everyone believes that. When you look at social stuff, last decade, all shale E&Ps had a well IRR model. They were all run by petroleum executives, generally in the middle part of the country. Not a ton of diversity there. And it doesn't have to be ethnic or gender. It could be points of view. Maybe they all need more East Coast oil equity analysts or people from other parts of the world. Who knows what they need? But they needed more than just the echo chamber that they had, I don't think they would have had 0% returns on capital. They had more diversity. So again, the S stuff I believe in, and I do think it's inexcusable if you have unsafe working environment for your workers, or if the air pollution or water pollution isn't handled as it should be per whatever the rules are. And so again, core ESG, it's a philosophy in how you run a company. And for me, the number one criteria in analyzing oil equities is always, do I trust this management team? And that's a capital allocation question, but it also is in part on these other factors. Again, when you get to the sort of climate only ideology, I do believe I'm an optimist by nature. I feel like I might be sounding too negative on this call. I'm a positive, optimistic person by nature, and I completely believe the world will wake up to this. The weird part about oil and gas is, again, no one likes going to the gas station. Definitely no one, even the United States, can even tolerate $5 a gallon gasoline. But the second you have to live without it, you are so grateful you have it. Where I live, we have regular power outages. Now, I'm fortunate enough to be able to have a gas-fired generator. Thank goodness. But not everyone has that luxury. Right? So, and when the power goes out, society breaks down. And so, I'll conclude optimistically. I don't know whether it's going to take 2 years or 10 years to wake people up. My sense is they're starting to wake up now. Even just this morning, a video was posted by a young social media team, at least younger than I am. And it was like a sensible approach to LNG. I was interviewed as part of it, but it gives me hope that younger people are starting to wake up to the misinformation they get from what I'm going to call climate only ideologues. The problem is not the climate only ideologues, just to be clear. They're totally entitled to their view. The problem is business people not using their brains to figure out where the misinformation is. It is not the fault of climate activists. They are 100% entitled to their view. Because of environmentalists, we don't have a brown cloud in Denver. We have the Clean Water Act. Thank goodness the Great Lakes are no longer on fire. The Hudson River, not a total disaster anymore. That's thanks to environmentalists. The problem is not environmentalists. The problem is business people and investors who fall for this stuff. Absolutely. I'm going to answer the question a few different ways. One of my core themes that I write about is believing in a super volatility type regime versus a smooth cycle. And so, one of the, I call it ironies of an environment where no one, mostly traditional investors, but also the ESG and climate crowd and all the related policies, when no one wants CapEx, I think you're going to keep going up to what I'm going to call demand destruction pricing. So you get like we had perhaps in the May timeframe, you get up to 120, $140 a barrel. And of course, if you're in European gas, that is $500 to $600 a barrel equivalent. Turned out to be that area's demand destruction price. So it's not a uniform price. It's going to vary by product. One really would look at local prices, whether it's diesel, gasoline, LNG, and depending on what exactly is the area of tightness. But when you get to demand destruction, the way you solve that is through recession. And when you have recessions, energy gets hit. And I am not suggesting anything otherwise. And the stocks can get hit. Now, when you look at past periods, when energy is the contributor, when energy is going to basically be a constraint on GDP growth, I suspect energy will outperform other sectors. But again, I'm not a macro strategist. I'm no longer even an equity analyst for that matter. I'm just a guy with a Substack who does some board and advisory work. I suspect energy might outperform, but can still go down on an absolute basis. And I think investors, people need to be cognizant of that. I think, frankly, companies need to figure out how they're going to manage through that when you do not have a capex response and you've got no spare capacity, no inventories, no cushion in the system at all, you're going to keep bumping into recessions regularly over the course of this decade. When I talk about good returns on capital, I'm very clearly talking about on average over the next 10 years. On a year to year basis, on a quarter to quarter basis, they can swing wildly. So sequentially, oil prices are down from the second quarter. So unsurprisingly, profits are down, and people should expect that. And I'm in no way, not only am I in no way suggesting the opposite, that in fact is a core part of my thesis. And I think individual investors or people, or for that matter, even companies, have to decide, do they want to just sort of buy and hold over the course of a decade? So I personally am very comfortable saying when I look back on 2030, if Michael's kind enough to invite me back to Lead Lag Live in 2030, and we look back, how did energy do? I think we'll have done very well. But there's going to be a lot of noise along the way. And again, when you regularly have to have recessions because you're constrained on energy supply and because nobody wants CapEx, either because they're climate diehards and think we can transition, or you're a traditional investor who said return stunk. Now, the sector does go together. So it's true that a midstream company might have lower notional volatility. I never understand why investors want all this smoothness. It doesn't really make any sense. Um, the volatility is part of things. Things don't go up in a straight line. And when you start having the mindset that they need to, you end up doing bad things. That's the companies that managed earnings, say in the 1990s, some of whom blew up spectacularly that I probably don't need to mention, but I think older people will remember. A lot of that was through earnings management, trying to reduce volatility. Is part of the game. It's part of the business. It is going to be what it is going to be. Um, but you have different dynamics. So let's just say you're running a large social media company and you're concerned that people aren't using your social media service as much as possible, or an even bigger social media company put on some ad tracking technology that didn't allow you to monetize as much, and you decide you got to switch to the metaverse. I'm just talking hypothetically here, of course. Perhaps your core product's going away. I don't believe that is the case for oil and gas. It has almost the most certain demand profile of any business out there across any sector. In 2050, we currently use 100 million barrels a day of oil demand. If in 2050 we are somehow using less than 100 million barrels a day of demand, it will be miraculous. And I'm willing to concede that as population growth slows, and if we are going to leave the 3 billion people behind, which apparently a lot of people want to do, I don't want to do that, but some people do, then you can construct a scenario where maybe demand is 80 to 90, but you can also construct scenarios where oil demand is 120. And I'd call that the reasonable range. How many products can say in 30? Are we going to have Peloton bikes in 2050? Is Instagram, which I think is still a leading app, maybe it's not. I don't use any of that stuff really. Is that going to be the leading app in 2050? Is Tesla's Model 3 or whatever like how many products can you say there's certainty of demand? Right? And so it's going to be a volatile business. The capex needs to go up. Costs go up when prices go up. That is part of the business. And if people are going to, not you, sir, but if people in general are going to freak out every time, then that's what creates the trading opportunities. I'm definitely not a trading type. I can see people on this call who are much better trader types than I am. I would go to them. I look at this as this is going to be a great decade for energy, in part due to the madness of the crowd. And that psychology has to change. So when we're in year 6 of a double-digit capex upturn, and when Canada has approved 10 new pipelines exporting the country, well, then maybe we should start looking the other direction. As I've always said, this is a cyclical sector, but the cycles are long term, 10 to 15 years up, 10 to 15 years down. It's going to be more volatile this time because there's no appetite for capex. You only will solve an energy supply shortage situation with higher capex. It is the only way. It's a physical business.
All right, so 3 things real quick. So unpopular opinion. First of all, I'm definitely kind enough to bring you back to Lead Lag Live. 2, obviously, I appreciate those that are helping and participating with this conversation. And 3, I think the only place that doesn't have carbon is the metaverse itself. Since you mentioned,
that's not true. That is actually not true.
I'm talking internally.
No, this is a great point.
Not the creation of it.
The metaverse does not exist without universe.
Right.
It was a Babylon Bee joke.
I'm joking.
It's a Babylon Bee joke that God creates universe to counter the metaverse. It is actually serious. The cloud is not something in the sky. It is data servers. And that is absolutely true of the metaverse. The metaverse, I know you meant it somewhat lightheartedly. Sorry to be psychotic about this. But the metaverse is absolutely driven by fossil fuels. And no one should think otherwise. It's not even a close call. And this is the problem. The problem with the world today. How do they think stuff gets powered? It's complete insanity. And again, I'll say it again. I am in favor of near zero methane. I am in favor of stricter labor standards than sometimes exist. I am for clean air and clean water. I am actually for lower carbon forms of energy. What I'm not for is delusional thinking. The metaverse uses oil and gas. Full stop. Sorry.
Right, unless it becomes like the Matrix, in which case we are the battery cells.
Josh, thank you. And for those, I actually only know Josh really through Twitter and his own great, Josh himself is a great follow on this. I think you raised a number.
And great person. I've had a lot of back and forth with Josh. He's very fair and it's very knowledgeable. And I'm saying this sincerely. So follow good people
Fantastic.
on this platform.
I think Josh raises some good points that I'm glad I have the opportunity to make sure I'm clear on. My own background, both as a Goldman analyst and now in terms of my current endeavors, I do tend to be very sort of large cap focused in sort of how I talk about things. And so I think people should be cognizant of that. I think when you start getting to the smaller cap space, that almost certainly is going to be the far more interesting space for people who want differential alpha. But I think unlike, say, the big S&P stocks, again, whether it's energy or for that matter, any other sector, I do think you need more energy specific knowledge. And so, Josh, you're an expert on this sector. There are many other folks out there, or probably fewer folks than there were 10 or 20 years ago, but where who has the better acreage versus the worse acreage? Who has acreage that currently is perceived as bad, but could suddenly become better? Who might be a takeout candidate? Who's actually going to do good acquisitions as a small company and maybe become a mid or large company? All these kind of things. I think you need differential knowledge, but if you have it, then that is going to be the most exciting area. It'll always, so almost by definition, if you're in a cyclical sector, which oil still is and probably will always be, it is going to be the smaller and mid-sized companies that have a chance to do much better. And frankly, some of my core philosophy in terms of how you kind of optimize dividends and returns on capital, it does not always apply to small companies. It is perfectly reasonable if you're a small company early, say in a new basin, to actually have some upfront capex. And you have to be sure that, again, let's just take Cabot Oil and Gas from 10 years ago. When they first went to the Marcellus, there's going to be some upfront cost to building out the infrastructure. The return on capital might be lower, but then it did turn out to be the future low cost resource. And so that's, I think, always the trick or the key to small cap. And there's a bunch of different ways to invest it. I just think it probably takes differential knowledge. I'd say a few other things just worth mentioning on the sector. You didn't exactly ask this, but I'll answer it anyway. My good friend and former colleague at Goldman will say energy tends to punch its weight in the S&P. Currently, it's about 10% of the S&P's earnings. It may actually be a little higher today, but yet energy is only 5.5% of the S&P. So simply if you get back, that's point number one. If we're in year two of a 10-year upcycle, then maybe we do better than that 10% over time with lots of volatility in the way. I think we will see. But your biggest bang for the buck will almost always be in the smaller companies. That's also where you might obviously have a chance to blow up more as well. I think in terms of the service companies, a lot of the quote discipline that we're seeing amongst the larger companies, you're also seeing it with the service guys, right? So whether they have their own dividend and whatnot strategies, there are almost no, as you know, Josh, independent oil service analysts anymore. We can debate whether that's a good thing or a bad thing, but they're all been sort of absorbed by the whoever covers the majors or the E&Ps now, which is a sign of probably where we are. So we're going to need the oil service industry to be here. Oil companies actually do very little stuff on their own these days. It's all done by Schlumberger, Halliburton, Baker Hughes, Liberty Frac Services, and all those types of companies. And they've had as poor of a historic return the last decade as the big guys or the upstream guys had. And so we're going to need them to add capacity. All those kind of factors are what cause these cycles to normally be 10 to 15 years up, 10 to 15 years down. Yet in all the prior cycles, we would already have started our rig build out, our frac crew build out. We would have started doing exploration again. And we're not doing any of that. And I think, Josh, that is kind of what might be more interesting about small cap today. Is there an opportunity where you're not quite as beholden to what the mainstream investor is going to demand of the large companies, rightly or wrongly? Some of it is rightly, but it's going to turn into wrongly, meaning you don't get to do anything. And that's not the right answer. You're going to have to spend some money. But maybe some of the small caps might be the ones that can zig or zag while everyone's doing the opposite. And I think it's a super interesting opportunity. But I would encourage people who are interested in energy. Again, my bias tends to be in writing and talking about the larger companies. There definitely are very good, excellent people like Josh and others out there who are much better at the smaller companies. I mean, it's a different area. So solar and wind definitely are competitors in power generation. If there was to be a major nuclear build out, which is what's needed, if you actually want available, reliable power, one can debate the affordability point, but that is where public policy perhaps can make a positive difference, or not, but it could. It would impact probably the outlook for natural gas, coal, wind, and solar. So there's power generation where there's always been lots of choice, and it seems pretty clear solar and wind might make sense at the 10 or 15% of the grid level. The idea that you can go to 100% solar and wind with the kind of grid we have today, with the kind of on-demand power that people's expectations exist, there's probably the biggest source of climate misinformation that is out there. There is zero chance you can electrify everything with intermittent resources. That's not a negative judgment on solar and wind. That's just being a logical human being and looking at this stuff. Nuclear is one of the answers. At some point, we're going to get started on it. And you kind of basically need the, quote, Marshall Plan of nuclear buildouts to have a chance. But that would impact natural gas and coal potentially, and wind and solar for sure. With oil, I always feel best about long-term oil demand. It is so hard to displace oil demand, and I am a bullish person on electric vehicles in the luxury market. I'm so lucky that I'm a retired Goldman partner and I can afford my Tesla. That is definitely not going to be true of large swaths of Southeast Asia, Africa, India, and it's absurd to think otherwise. Never mind all the raw materials and mining and all those kind of issues that people are starting to wake up to. It's going to be a niche. For sure, we don't have the kind of fuel economy gains that might be able to lower oil demand in the future. And again, we have 3 billion people have nothing and 2 billion people come in the world. So again, I remain an optimist actually in oil demand, certainly relative to the very pessimistic expectations. So, Michael, I want to be respectful of your time. You've been so kind to have me on this Twitter Spaces, and it's been a real pleasure to talk and to get everyone's questions.
Yeah, no, great conversation. Appreciate those that were helping with the questions. Again, I'll make this an edited podcast on all your favorite platforms. Thank you, Arjun. Really do appreciate it. We'll definitely do this again. And everybody enjoy the rest of your day. Thank you, everybody.
Thank you.